So, what's up, guys? And welcome back to another episode of my channel to talk about investing. And in this episode, I actually want to go through one of the foundational concepts within Investing Accelerator. It's about trend and why I don't look at the daily change of the market. So if you're a new investor, I think it is very easy to fall into this mistake where you're constantly looking at the daily change of the market. And I used to do that when I was young. Well, I still look pretty young right now, but I used to do that when I first started investing. So I want to go through the rationale for it, give you the data to support it, and then after that, if you have any questions, you can leave a comment below on how to think about trends, even if you don't use any indicators at all. So I'm trying this new setup where I put my face kind of on the left of the screen. So if you like that, give me a thumbs up and I'll continue to do that for future videos. So before we start, I just want to celebrate another 4 successful case studies where Flo made 104% from Intel in 41 days, Annie made 104% from Intel in 10 weeks, and Arian made 100% from American Express in 3 months, and Peter made 30% from FSLY in 3 months as well. So congratulations to you all 4. These are very successful case studies. I'm happy that you guys were successful after learning investing. So let's dive in. So the reason why I'm making this video is because I notice a lot of people like to look at the daily change, myself included. It's kind of continuous, it's real time, it's exciting, and it just kind of gives you that adrenaline rush, you know? You're looking at the daily change, oh my god, it's going up, and you look at the daily change, oh my god, it's going down, and it makes you feel really involved, even though investing is technically the least involved activity ever, because once you make a decision, you invest in a stock, it's just a matter of sitting on your hands and let it play out. And if you're right, obviously you'll make a lot of profit. If you're wrong, then well, you need to work on your risk management. So why don't I look at the daily change of the market? Or at least I avoid looking at the daily change of the market as much as possible. Now, here is actually the chart for S&P 500. So this is SPY. And here you can see for the last couple of years, it is a very nice uptrend. So if you're wondering how I got this whole template going on, it is the free chart course, which I offer in the description below. You can just register for it. It's a first link in the description. So here you can see price has been consistently going up. You know, in 2018, S&P 500 was at 260. This is the ticker SPY. 2019, it's going up a little bit, 280, 300. And then in 2020, there is this COVID dip that you see here, and afterwards it rebounded, and now we're at 400. Okay, so you can see the trend has been very strong. And if I zoom out a little bit here, then you can see it has been this strong for many years, ever since 2009, which is the previous crash. And even if you include the previous crash, which is the housing bubble, the trend itself is still very strong regardless. So when you think about S&P 500, what do you think is the percentage of up days, and what do you think is the percentage of down days? So up days meaning that day of the market is going up, and down day, the market is going down. So looking at such a strong trend for the last 20 years or so, take a guess. What is the percentage? Because this is going to be important. And if you get it right, then of course, congratulations. Stick till the end to find out. If you get it wrong, take it as a lesson. Because when I was learning investing maybe 13 years ago, I got this completely wrong. I was actually very shocked by the result. Because, well, I thought for such a strong trend, the number of up days must be important or really high in this case. So when I was, writing different programs to learn how to invest in the market, I had the wrong assumption basically. So when you're building a model, you need to create specific rules to basically enter and exit into the market. And what I was trying to do is to use machine learning to kind of predict the next few days or even next few weeks or even next few months or next few minutes on what is going to happen in the market. And if the programmer, which in this case is myself, have the wrong assumption, then that is very problematic because you can't program the correct model which mimics the market movement. So that's why this is an important assumption, and it links back to the psychology of checking the daily change of the market every day. So if you have finished your guess, leave a comment below. There's no right or wrong answer because I bet most people are not going to get this right. So what is the number of up days as a percentage of 100 versus the number of down days? Okay, so you have written down your answer. So let's go to the data. So here is a PDF I found online. I could have done this myself using Excel and pivot tables, which is relatively easy. Just download the S&P 500 data. It's quite simple. So here you'll first find for the last 50 plus years, the percentage of up days and down days is 53% versus 46%. Okay, now you look at this number and you go like, this is actually awfully close to each other. So now let me go back to the S&P 500 chart and let me zoom out for you for 50 years. Okay, so I'm going to go out really fast. Okay, they don't even have that much data. The earliest data was 1993. So here you can see this is a straight up trend. Okay, from 1994, TradingView has $41 all the way up to 400. Okay, so that is what? 10x increase? Sure. But the percentage of up days versus down days, the difference is only 3%. And I calculate the 3% by taking the 50 to 53.8, that's 3%. And if you take a look at the decade split, which is the little box below, 1970s, 51%, 1980s, 53%, 1990s, 53%, 2000, 52, 2010, 54, and most recently, 2020s, 57%. So yes, there seems to be an increase in terms of the number of up days in the last 10, 20 years or so, but what's important here is really to observe how small the change is. And even though there's only a slight difference in percentage in terms of the up days versus the number of down days, it creates such a strong trend. Now, when you take a step back and think about this piece of data, it is actually very important because if you try to model and create an AI and try to predict whether tomorrow, next week is an up day or a down day, I think you're going to have a lot of trouble creating that kind of AI because it's not going to be very helpful and your margin of error needs to be very small, which means the probability of you making a mistake. So then it wouldn't be a very good model. And when I first started, I actually thought it was going to be 90%. So if during an uptrend period, it would be 90% going up versus a downtrend period where 90% would be going down. So meaning 9 out of 10 days is going up and 9 out of 10 days is going down would create the trend. But turns out that's actually not true. So it's actually a very, very small difference which will create the trend. And I think this will completely change the way you understand the market, especially if you are looking at the daily change. Because looking at the daily change is very exciting. You know, it's moving up and down, ticking up and down all the time, and it's very addicting. So if you understand that, hey, maybe it's just a small percentage change, even if it is in an uptrend where the market continues to go up, 46% of the days are going down, but the market is going up. So over the long run, the market is going up even though 46% of the days are going down. Are you getting it? This is important because if you understand this fact, which is based on data over the last 50 years, then you'll understand, well, there's really no need to panic if the market is down one day or down a couple of days. Because even in such a strong uptrend like S&P 500, 46% of the days are down. And this is kind of the key pillars of my investing strategy and also a significant turning point where I suddenly realized, hey, perhaps it is the opposite. So instead of looking at a down day, looking at red as panic, it is actually an opportunity. Perhaps looking at up days as good, it's actually just progressing as what it should if the stock has an uptrend. So if you want to dive a little bit deeper into trend and how to use technical analysis and so on, then I would suggest you to go to the first link in the description below to take the free chart course. So it's free. The training is 4 hours long. And I explain a lot in terms of the kind of analysis I do in terms of investing. So let's dive a little bit deeper into this PDF, because I want to make sure that you don't get misled by the data. So I'm going to skip over these two boxes. They're basically showing you the same conclusion, where they're showing you the last couple of years, which doesn't really matter too much in my opinion. So what I want to clarify is really here. So what the author is trying to do is to create some sort of separation, or basically giving you some sort of signal. So here you can see initially in the 1970s, the number of up days versus the number of down days is 51 to 48. And then over time, the difference is getting larger and larger and larger. And you go like, huh, that's actually quite interesting. Except you need to look at the scale. So when you're looking at the data, it's important to look at the scale. This is actually 60% to 40%. Now, I understand what the author is trying to do. They're trying to create this kind of signal so that it's clear what the difference is and that it is increasing. But if you look at the entire scale, then it's only a couple of percentage points difference. So it went from 51 to 57 versus 48 to 42. Now, of course, there's going to be volatility within these numbers. So when you look at the full scale, which is 0 to 100%, what's important is that across all 50 years or so, the number of up days as a percentage is more than the number of down days, which is good. And if you look at the number of down days, it is still around 40-something%. Yes, it used to be 48% in 1970s, now it's 42%, but it's still within this range. So if you think about, sometimes the market performs better in one year than another year, you need to think of the data as kind of like a fluctuating. It's kind of like doing this. So you're really looking at a range between 48% to 42%. So in any given year, it is probably going to be fluctuating within this period of time. This percentage, I mean. So when you think about that, then you can have a proper expectation on what's happening in the market. Meaning that when you're investing in a good stock, you do your research, technical, fundamental, and all that, and you invest in it long term, and you see a down day, you don't panic. Because you understand that 40-something% of the time, the stock will show a down day even though the long-term trend is up. So now you realize that doing your research is important. Understanding how the market works, the behavior is also important. And once you combine all of that together into one single strategy, then you'll be making quite a healthy profit. So if you're interested in learning more about how I invest, then I will invite you to attend the free training below. So it is a 4-hour free training called How to Get 30% from the Market. It is free. It is 4 hours long. It's quite long, so you can go through it in one sitting, maybe with 2 cups of coffee, or multiple sittings across multiple days. So once you watch the free training, and if you're interested in learning more, then of course you can schedule a call with me to chat to see if you want to be part of Investing Accelerator. And this month, I'm looking to help 20 people without a financial background to learn investing. So if you want to be one of the 20, then you can schedule a call with me. And I'll see you in the next video. And of course, if you like this kind of format where I set up the data, I explain the concept and why I do what I do in order to become a more successful investor, just hit the like button. I would really appreciate that. It would really tell the YouTube algorithm that this is a good video and you like my face on the left-hand side, basically. Okay, I'll see you in the next one.